Guys, it's good to see you. Phil, I mean, it's obvious that the market is, they know goods deflation is softening, but it's the job market. And signs of a strong job market, as we saw with the ISM, is going to lead them to think the Fed's got more to do.
Yeah, Carl, here we are in 2022. There's no relief in sight, where you have, it's September. Kids are headed back to school. We learned a lot of important lessons over the summer. First thing is, as you said, prices are coming down. We believe inflation peaked in June. There's plenty of evidence. Gas prices, used car prices, even 1 year forward inflation is down to 2.5%. Okay? After it was 5.5% in June. The bad news is, just like Serena proved last night that she's not done, Fed's not done, right? So we have about 80 basis points more of tightening that was priced into August. Carl, that's the reason why we're underweight stocks in our portfolios, is because, as you said, they're shifting their focus away from inflation, which is coming down, towards the jobs market. So when the job openings tick higher, when unemployment claims move lower, and you're actually rooting for bad news in the jobs market, that's not a great place for sentiment, which is, again, why we're underweight.
Right. Delano, I mean, how does that weigh on bulls' sentiment? Is there a sense that the Fed's moving the goalposts, or do you think that they've always said, look, it's going to be about the labor market and, I guess, shelter to some degree in the end?
Yeah, I think there's a little bit of that when you talk about moving the goalposts, because, we still obviously with inflation, and obviously there could be signs of a peak. If you look at even down to the consumer, there's still that feeling that we're still way too hot, and the prices and bubbles in certain areas of the market, and obviously in certain prices for the end consumer. You could talk about the high end versus lower end or higher income. They're still really, really high. And I think when you think about the sentiment currently, not only in equities, but just in general economy, it's not very good. And if you look back at businesses and how they're revising earnings lower, and even now the news that we got of lockdowns, that's not going to be good for supply chain and earning estimates going forward. I think we still want to, focus on inflation, especially for, growth stocks and equities going forward, Carl.
Phil, when you look at the direction of the market, and to Delano's point, the sentiment doesn't feel great. Yeah. It feels fairly negative. Mm-hmm. But to your point, if inflation has peaked, do you not think we still have further to fall as this trend continues lower here?
Yeah, Courtney. Yeah, that's what we're talking to our clients about. We do not think we revisit those lows from earlier in the summer. Why? Because headline inflation is moving lower, and at the end of the day, that was so painful. Remember, gas prices were $5 a gallon when we were most bearish. They're now, even in New Jersey, $3.79 a gallon, right? So it's a much better place there, but the Fed squashed any idea in Jackson Hole that there was going to be a Fed put anywhere in sight. In other words, one of the reasons why all those mega cap growth stocks rallied so much was because of easing that was priced in pretty soon, right? In summer of next year, all that has been pushed out. Federal funds rate's getting to 4%. So you have to take off the highs that we saw earlier this summer, but also the lows because of inflation. We think about 3,800 to 4,200 is a tradable range on the S&P.
Phil, why don't I just, I got a 10-year 3.5% right now. First time I've seen that number in 15 years.
The 2-year, yeah.
Yeah, the 2-year.
Yeah.
Excuse me, thank you. The 2-year. Why don't I just park some money there and take a break?
Yeah, I mean, we used to tell clients all the time, cash is the worst thing you can have in your portfolio. Well, when the federal funds rate, the free policy rate is getting to 4, it looks much better for us right now for client portfolios. Fixed income also looks good. You mentioned the 2-year note. Fixed income as a way to manage risk also looks good in the portfolio in addition to cash if we do slip into that growth concern, which we don't see yet. We don't have a recessionary view, but much more interesting in the front end of the curve, David, to your point.
Shepard Smith here. Thanks for watching CNBC on YouTube.